have about 30 minutes for the Q&A, so I think we could probably get to everybody. And if we have time, we'll go around for another one. So we'll start it off now. Sal?
Thank you very much. Salvador Tiano, Bank of America. I'm just wondering, with the focus on innovation R&D that you discussed before, have you set any specific financial targets, metrics, or benchmarks for your R&D investments? And is there any, for example, compensation scheme tied to that?
Yeah, let me turn it over to Mike.
Sure. Yeah, so we do set targets internally for annual new product revenue from new products, and that's built into our annual bonus scheme. So there are components of our compensation that are based on our ability to deliver against top-line growth from innovation. We also benchmark the organization against the competitive landscape in our peer set in terms of project cycle time, how quickly can we develop new products, how quickly can we be ready for product launches 2-3 years in the future, so readiness targets. Plus, we also have a stage gate process that helps us to manage risk and spending as we run projects. So, all the metrics you'd expect from a R&D organization for a company like Ingredion, we have in place. But, top line growth is a key part of our incentive scheme, not just for the innovation team per se, but also as part of our go-to-market team's incentives as well. So we're all working together.
And also, obviously, solutions, right?
Correct.
We're going to be measuring, and we are measuring, solutions because we have that definition, strict definition. And then from a standpoint of building that into incentivization, Jim is working on the governance, the financial governance model, which we, by the way, had in place for specialties. For those of you that have covered us for a long time, we went back from 2009 to 5% specialties to, I think, 34% before we transitioned to the resegmentation. And that was a strict governance process that Jim had in place to track it, and we had incentivization in place for that. We're evolving now for the same for solutions selling and what constitutes solutions.
Go to Ben here. If I could just remind everybody, if you could just state your name and your company, just for the record, that'd be great.
Okay. Ben Toro, Barclays. Just following up a little bit on the capital flexibility and the opportunities of growth. So if we take a look at your balance sheet, and you've highlighted very low leverage ratio with a target that is higher, and at the same time, obviously, the growth opportunities within Texture and Healthful Solutions. So just wondering, as you look into the balance between M&A or organic growth investments into T&H, just given the flexibility of the balance sheet, how could you potentially accelerate some of the growth in T&H using just the strength of the balance sheet, be it M&A or investments?
Yeah, well, I think it's a great question because we've often thought about our capital budget, and we've highlighted that we like to put about $80 to $100 million a year towards organic growth opportunities, and that tends to be kind of a nice pace for setting up the type of growth that we're looking for and really Texture Solutions part of the business. But please understand, we may have a lot of discretion and flexibility, right? If we found that we had 2, 3, 4 plant investment opportunities and they were going to overlap, then we'll come back and say, hey, we're changing our growth investment pace, and we'll reflect that in terms of how we're thinking about tapping the balance sheet or actually the cash flow generation. So I think organic growth, we really shouldn't be kind of constrained by necessarily what's on the balance sheet. It's really actually, do we have the people to actually make sure that we're building the type of asset that we want with the right type of process, if we have partners involved with the right type of partner structure. Maybe on the M&A side, to the extent that we actually see that we have M&A, particularly in either Texture Solutions or Healthful Solutions, that can actually accelerate kind of the strategic position that we want to be in. I think we've always said that we'll take that approach, but even more so now as we've, I think, really tightened our portfolio, we're seeing those opportunities in that broader space of Texture and Healthful Solutions, that $20 billion market. That's probably our first priority.
Yeah,
Yeah.
I would say, we're opening up the aperture as it relates to all the things that can influence texture beyond starch and hydrocolloids. Because we see trends towards, obviously, clean label ingredients, process technologies. So our aperture as it relates to how do we become that comprehensive go-to provider for enabling texture solutions, along with the fundamental understandings of the why behind it, which Mike talked so well about, that will also come into the consideration set for M&A, for example. So hopefully that gives you a good feeling for where we're looking at deploying our balance sheet, for growth through M&A.
Kristen?
Kristen Owen, Oppenheimer. I wanted to ask about your other portfolio, because you've called out both protein fortification and sugar reduction in your texture opportunity set. Previously, I think we had a target where we were looking at break-even profitability in that other segment. Just wondering, how should we think about the growth of that other segment as it relates to the solution set for protein fortification and sugar reduction?
Yeah, let me ask Jim to just first remind everybody about what other is comprised of and how that's evolving. And then we can maybe have Mike talk about what's happening in protein, and maybe Rob can talk about sugar reduction. So why don't you frame it first?
Right. So, I mean, our other, all other grouping of our reporting is our Pakistan business, in which we own 70%. It's our protein fortification, and it's our sugar reduction business, which is primarily PureCircle. And I think over the medium term, each of those businesses are both growing and kind of improving the overall bottom line. And so we just, as we look forward, right now I think we have some guidance that we're trying to get to break even. So continuing to lessen the loss on the protein fortification, growing both the top line on both the protein fortification and the sugar reduction businesses significantly, and then having our normal kind of expectations for a Pakistan business. Maybe turn it over to.
So there's been significant improvements the last couple of years in our protein fortification business, which Jim's right to highlight, because we have highlighted it publicly, that it has been loss-making. That being said, we're mitigating the loss each year, each successive year. And Mike, under his leadership, really has driven a lot of the R&D innovation for the preferred products. But why don't you talk a little bit about the growth that you're seeing, the pipeline that you're seeing, and how the R&D pipeline is looking there?
Sure. Well, there's significant tailwinds behind protein fortification as a category. And we're enjoying the benefits of that. We've grown the business significantly over the past 2 years and have taken advantage of the capacity we have. So we have better fixed cost absorption, terrific top line growth, and we believe that protein fortification, in conjunction with other elements of our portfolio like sugar reduction and the texture portfolio, will continue to represent a pretty strong area for growth for consumers. We don't think that the demand for balanced nutrition, and especially a focus on protein, is going to wane anytime soon. So we talked about 200D as an example of innovation in this space. Again, it's our newest product and has really exceeded our expectations less than a year after introduction. And we're continuing to look for ways to diversify that pipeline to address consumer needs that balance nutrition and texture. Because again, the biggest challenge with a lot of these products, if you want to put a meaningful amount of protein and a nutritionally relevant amount of protein in these products, is how do you maintain that desirable texture while you fortify? And we're making significant advancements in that space. But we've been very happy with the growth that we've seen and are doing our best to keep up with demand at this point.
Yeah, I think sports nutrition, meal replacement, the GLP-1 diets that are driving the protein fortification, all very positive. Rob, why don't you take sugar reduction and what we're seeing there?
Yeah, I would just say, first of all, from a trend perspective, it is truly global, right? You think about, I mentioned even LATAM, front of pack labeling, added sugar. So it's a global trend. And I think to Jim Gray's point, it's in an accelerated growth period. So we're over-investing in people, resources, R&D and actually products as we go forward. But you think about our portfolio today, as mentioned, we're the largest stevia producer in the world, our allulose investment, look at fiber. And the beauty of it is when you take sugar out of a product, typically if you replace it with a high intensity natural sweetener, there's a piece of that that's missing, right? And that's that texture build back. So it's a beautiful combination with texture. You pull something out, we deliver the sweetness in a natural format, we build back the texture with our other portfolios, including potential new fibers as well. So we're very excited about the growth of that. The trend will continue, and I think we're positioned in the next 3 to 5 years to capture that trend and truly be the leader in global sugar reduction from a food ingredients and solutions point of view.
I think as Rob just said, when you replace sugar, obviously, you need the high-intensity natural sweetness to build back and replace the sugar, but also you need the mouthfeel. And that's where the synergies between us being a texturizing company as well as having the high-intensity natural sweetness is very synergistic.
James.
Hey, James Cannon, UBS. I just wanted to ask on the innovation platform as you try and move that to more of the innovation as a service consultancy format. What do you think differentiates your platform from any of your competitors? And maybe on the M&A front, is there anything in the portfolio that you could specifically call out that you could stand to bolster through the M&A market?
So why don't I ask Mike O'Riordan to take that from a standpoint of how we're approaching that is different from others and different this time for us as well.
Yeah, so I think some of the competencies that we have that would differentiate us from some of the others is in the area of clean label, deep expertise in that area. I think we've also built over a number of years a very deep understanding of consumer insights and our ability, and we've been analyzing that for some time, on the consumer liking and linking that back to our texture. I think we're pretty advanced in that area, and now we're obviously looking to scale it with some of this AI tools. So this gives us the right, I think, and we've got the respect of the industry to really go out and work closely with a number of customers. And customers are coming to us as that go-to provider to look for some support in launching their products. And we've run some pilots already, and we've had some very, very positive feedback in our ability to significantly reduce the launch time. What happens to traditionally, companies do outsource the early stage of launches, but where it fails very often is scaling it up industrially. And so companies come with a nice prototype, but to actually scale it up and the affordability of industrial ingredients to actually bring something successfully to the market, that's where sometimes it falls down. And we have that expertise along the entire value chain. And so the probability of launching something successfully in the marketplace is increased because of that competency. So we've done pilots. We're piloting around the world. We've started in the US. We're now looking at some other markets. Sometimes the needs of markets are different. And so we're just taking it step by step to see how do we get the balance right in terms of being able to scale it correctly, and then what's the best way to monetize it, always thinking in the mind of the customer, why it creates value for them and why they'll keep coming back to us time after time, so that it's a win-win for both the customer and ourselves.
Yeah, I want to be clear, it's not all contingent upon the service model. The service model is one complementary aspect to the overall solution selling, and I would say what's differentiating us today is the amount of training that we've put in place with the go-to-market teams globally and how they need to pass a certain level of proficiency in relationship to a solution selling certification. So we actually have the person that I was telling you about that reports to Nancy, who's been leading this for us, has developed a whole certification process for proficiency in how to actually sell solutions. So we've invested deeply in that. And there's role playing with customers. There's what's called a digital brief that you guys could probably do better justice than me as to what constitutes that. But Mike Leonard said something very profound actually during his presentation. I'm going to ask you to say it again because you're going to be able to say it better than I can. And that is, in R&D, one of the most important but most difficult things is up front defining the problem, right?
The problem to solve.
The problem to solve. And so we've put a lot of work in that digital brief upfront part of making sure our go-to-market teams understand how to engage a customer to not just try to bring a solution up front, but to define the problem up front so that we can deliver and design the right solution. So there's all of that I think we're 18 months into this and we're feeling very good about what we see. Then this service model is something that, to be quite frank, we don't know exactly how big it could be or what it will contribute. We think there's going to be a high percentage where we're going to get the ingredient sale along with it, of course. We're not actually holding customers' hands to that. But there's a fee for service that will compensate us, make us completely whole, and maybe some other things that they're willing to do in response to speed and also probabilities of success. So we're very excited. This has also unleashed a lot of excitement in our go-to-market teams as well on the way they sell.
Pooran?
Hi, Pooran Sharma from Stephens. Just wanted to revisit the comment about kind of shifting away from HFCS over time and finding other uses for the grind. I believe you mentioned there, you're in paper making, kind of sustainable packaging. And so I was just wondering, over the intermediate and longer term, what do you think that mix can get to? I'm looking at page 8 on the deck, and I think 2024 revenue had about 19% industrial applications. So I was just wondering, as we think, intermediate term, longer term, how much further can that go up? And B, as I think about the margin potential of these products, I know texture and healthful solutions have margins that are twice that of core. How should I think about the industrial applications and these sustainable packaging margins?
Yeah, let me have both Rob and then Jim Gray tag team on this one, but let's have Rob go first, and then Jim, you can.
I'll say initially, as we mentioned, it's approximately 10%, just slightly under that in terms of total revenue today. Maybe the history, Jim, you can comment, but it was probably a lot higher than that 5 to 10 years ago. So over time, as that demand has shifted away from high fructose, we've pivoted towards, as you've mentioned, an industrial applications in starch, so we can use that stream to make more. We just made an investment in Cedar Rapids for $50 million to put in another starch dryer. But also the other opportunity there is around liquid dextrose. So instead of making that fructose product, we'll use that, and Mike's working on a fermentation strategy in that space as well. Enzyme manufacturing, green chemicals. So those things are happening as well. So as I said, it's not been a black swan event where it's dropped 30%. It's kind of been this 1% to 2%. And I think for ourselves, this focus and pivot of keeping our plants full. From a profit point of view, if you saw though the mix, the margins are very healthy right now in our US-Canada business, right? So they're not double below where maybe T&HS is as well. So we're at some fairly profitable levels. So the idea is to perhaps replace that, but have it on more of a consistent basis, right, in a growth category. So I don't think we're looking to double the margins in that particular space, but if we can find opportunities to sell those products at similar margins consistently, and a lot of those deals too are long-term deals where you may be co-locating as well and provide that predictability, which I think again is very important from an investment point of view.
So Rob, obviously, to answer the question, we're obviously trying to control what we can control to mitigate our own exposure over time to that. But Rob also said something during his presentation that I want him to repeat in regards to what we see also happening in the industry that also sees the same challenge and some of the steps that are being taken. So you mentioned, for example, the Sustainia investment, and just give them a feel for size of how significant when and if that materializes, and we understand it is progressing, but what that does to the industry as well.
Yeah, if you think about that opportunity, which we participated in the evaluation of our own Biomag, which is to make plastic bottles and things like that, it was approximately 800 million to 1 billion pounds, right? Which, depending on who you talk to, could be 3 to 5% of the full industry, with what we've seen longer term plans to double or triple that size. So when you think about, hey, a 1 to 2% reduction, as I said, it's not necessarily about closing any plants, it's about what can you do with your plant differently. And those opportunities are real and moving forward, these co-locations where they're tapping into efficiency, energy, water, and all those things, and you're going to supply a pipeline over them to make these products. So if that demand continues, which we think it will, we think that we can offset the potential reduction in HFCS, along with some of the other things, like we mentioned industrial, but also on the food side, products like glucose. It's actually not shrinking, right? It's doing very well in the marketplace as well. So we feel comfortable keeping that supply-demand balance. The other one portion you mentioned around margins as well, these are usually big fixed cost absorptions. Our plants are pretty big, so we need to maintain that level to keep our cost level at the same level as we make other products in those plants as well.
And the other thing, and I'm going to put Rob again on the spot, the other thing is, you know, all of us are obviously most familiar with the big kerfuffle in relationship to the Coke situation with HFCS, right? Coke handled that situation, we thought, extremely well with the statement that they then issued in relationship to HFCS obviously being safe, a very important and affordable economic ingredient as well. And Rob, you're very familiar. Just explain the outlook for HFCS from a standpoint of how established it is and what your sensing is in relationship to the threat of sugar from a standpoint of the U.S.
It's obviously a very large market for the industry here in the United States and Canada, and for Mexico as well. I know there's this portion that, hey, refined sugar is used in Mexico. They actually use HFCS in their products down there as well. I think as it goes forward, I don't think there's intention to move away from high fructose corn syrup. Pepsi has tried this, Coke has done it, it's kind of a niche product, and theoretically there's just not enough refined sugar to ever come close to replacing high fructose corn syrup. In fact, you would probably have to go and import sugar from Brazil, which now is a 50% import tariff, and you're actually going to hurt US farmers, right? So you think about that balance as well. Corn grown in the Midwest, used by our industry in the production of those products, it wouldn't make sense to replace that with refined sugar as well. So there's not only maybe a theoretical approach, but there's also an economic and what is actually available approach to replace that product. So again, we monitor it very carefully. Consumer preference drives that, but again, I think I feel very confident about what we're doing within Ingredion's control to make sure that our plants are full and looking at those pockets of growth in the industry.
Noah?
Heather?
Heather Jones with Heather Jones Research. I wanted to ask a clarifying question on assumptions for the top line. So you had mentioned that you're holding price flat. So of that 2 to 4%, do you have a rough idea of how much of that is volume versus upgrades and the visibility into the upgrade side? And then you said you're not assuming any economic weakness. And so there are some economies out there that are obviously struggling right now. Are you assuming a recovery to normal, or are you assuming what we have today is the status quo for your assumptions?
Yeah.
Thanks.
Maybe I'll take the first. So with regard to, again, it's probably most relevant within texture and healthful because that's the biggest growth. You know, the underlying markets that Mike and the team are competing in, you know, from a volume basis, those are probably 2 to 2.5, 3% type of volume growth. So one, there tends to be a skew towards populations in the world that are both larger as well as growing faster. Two, there's also a skew towards younger populations. You know, Rob has highlighted those, but also across Asia, across Africa, and some of the Middle East, where you have younger populations and kind of rising household incomes, which tends to drive demand for packaged foods. So, you know, the two big drivers there are probably probably 2.5 or so %. And then the rest is really driven by upgrade, right? So just as Mike mentioned, hey, if we're going to sell more clean label is a higher price per ton to our customers than, say, a PO waxy starch versus an acetylated starch versus a native food starch. And so what we see, whether it's in developed countries pulling even more functional products that have to abide by wellness and labeling and a lot of the trends that Mike and Jim highlighted. Or we just see greater functionality moving from just a native food starch, which doesn't have a lot of functionality. It's affordable, but doesn't have a lot of functionality. And we move to that first modified level. We really see an uptick in terms of the value that the customers demand. And so that's really that mix as we see that country by country, product line by product line. That's really driving.
I comment.
Right. Yeah.
Sure. Yeah, so the other thing we can do, and I think you referred to that, is we're able to correlate our pipeline to future outlook in terms of what we think. So I think in the 4 to 6% range for Texture and Healthful Solutions, we're pretty confident looking at the pipeline, just like you said, Jim, in terms of what percentage of that is due to market growth and reformulation, probably around 3%. 1% of it is coming from the innovation, 1% is coming through market penetration. So we are pretty confident when we look at that pipeline of being able to grow at those sort of levels.
Yeah. The only other thing that I would say is obviously in the near term, we're all observing what the unknown impacts of tariffs might be. I don't think the full effect of that has made its way through the economy at large. So always there's going to be some short-term watch outs, but long-term we feel the market positions that we have, how we're positioned, the competitive advantage, and our strategy and our ability to execute, and how we view the trends and how we're positioned, we feel very confident long-term in relationship to our ability to deliver on the growth targets.
Yeah. And then maybe the second half of that question, though, was kind of which economies around the world and where they're at. I think, someone asked a little bit about Mexico. Right now we're looking at Mexico to date in 2025 and seeing some economic slowdown. Can be related to remittances, which Rob had highlighted. And so I think we have to be able to say, hey, if you look forward over a 3-year horizon, how have various economies performed? And so we kind of would assume kind of a return to an average type of historical growth, right? So, maybe that'll be new news, right? I mean, we highlighted as a risk trade agreements. Who knows what that posturing can be 26 and 27, right? So just stay awake.
Good, Charlie.
Charlie Rose with Cruiser Capital. The question I have is back to the stock market issue. Your multiples that you were showing, Jim, were all based on TTM analysis. And when you go forward, your multiple's even lower. It's probably in the 7s. And then you look at your free cash flow yield and you look at your deleveraging effects. Is this industry ripe for some consolidation, or is it just going to be bolt-on acquisitions, or is it going to be some other distribution of dividends, or what's the game we're playing? Because you're entering a new financial format that's different than it's been a couple of years ago when you were sort of adding on pieces of the puzzle to sort of reshape the company a bit. Now you're in a game of obviously financially integrating these businesses and getting the company on a trajectory of some form of steady improvement. So I don't quite get what the shareholder equation is yet, because you are in a deleveraging mode that's quite remarkable, and it's good. I'm not saying it's bad, but the question is that how do you? And I'm not trying to be negative. I'm trying to understand what do you want to accomplish? What are aspirations maybe that you'd like to see realized as a result of these issues?
Charlie, I may not have all the answers to your questions, but I'm gonna state the one that's most obvious, I think, to us, right? Which is the reason that we wanted to create a global Texture and Healthful Solutions segment is to focus on the addressable market opportunity that we think is around the globe, right? Traditionally, we've had local idea labs. We now have a centralized R&D team, led by Mike, We have a global innovation focus across that, which is, we're terming solutions. And I think that allows us not just to sell the next texture, but to actually get into other products that offer either fiber fortification, other means of texture solutions within specific categories. I think it allows us not only to go deeper within certain customers, but also into adjacencies that we will invest in all day long, right? And so right now what we can see is an algorithm for Texture and Healthful Solutions, which is 26 and 27. Trust me, the upside that these teams are working on, I think, is beyond that, right? We're just, at this point, say this is what we can see, but we're thinking about our innovation, we're thinking about our customer pipeline, as Mike has highlighted. We'll use M&A to accelerate that. I think that profile of what Texture and Healthful looks like globally is really, I think, something that we're all striving for, and it's part of our purpose that we as a team has outlined.
Yeah, I think that what we're striving for is to continue to execute extremely well and leverage the assets that we have to continue to drive growth at a higher rate and increase. Jim and I were talking during the break about just accelerating the probability of success, which we think we can do with Texture and Healthful Solutions that will grow volumes, higher margins. The other thing is, and this is important, is there is an opportunity in our business to further increase fixed cost absorption through volume growth, and a tremendous positive lever, we believe, from a standpoint of incremental value creation. So, and at the same time, look, we are going to look to use our balance sheet to grow where we think M&A at a reasonable value, at a value where we can create value long-term for shareholders, makes sense for us. So that'll be part of the equation going forward as well.
So this brings us to the end of our Q&A session. But the presenters, as well as our extended management team, will be around for lunch. So please join us in the next room for an interactive lunch. Thank you.
Thank you. Okay, thanks.